Hello, welcome back. In the previous few weeks, we have been talking about interesting companies in our Discord channel. And one of these companies that a lot of us like a lot right now is Crocs. And this is obviously a footwear company. And again, we have been talking about it in our Discord channel. You can feel free to join us whenever you like. You can find a link in the description box below. We're having some great discussions about all sorts of different companies and economics pretty much. And so we'd love to see you there. And you will see the logo here, Crocs, you know where these are, well-known footwear. And it's very interesting, this company, because you will see that it has been down about 70%. And in the last 5 years, take a look at the growth over here, has been tremendous. And now it's going down again, potentially giving us a nice entry point. Now, of course, we did not just buy and because the stock is down 70%. We want to be buying because it's sound financially and we can actually make some money in the long run. So, if we take a look at like the 3 month chart, you will kind of see the downtrend here, and the 6 months it's even more obvious. Now, let's see what the financials of the company are. It's sitting at a PE of 5 here, which is going less and less and less and less, actually down and down. And the price to free cash flow ratio of 6.76. These are things that I love to see, you know me. And outstanding shares that are going down is another thing that I love to see. The company is buying back shares. And their actually total liabilities to free cash flow ratio is actually 3, which means that it is relatively low. It takes about 3 years of last year's free cash flow to pay back all the total liabilities the company has, which includes long-term debt and everything else really, even supplier debt. And the 5 year revenue growth points to a company that has been increasing their their revenues pretty nicely here. And revenue growth has been increasing tremendously well, along with the free cash flow too. And it's only the total equity here that has been going down, and that can be a little bit concerning here. So it's been going down quite some in the past few years, although it wasn't too much to begin with, but still it's going down, and we need to examine why this is happening. Now, you will see here debt to equity ratio of 65.4 points to very high debt here, which again we will examine. This is high debt compared to the equity, though it may be still relatively low as an absolute number. We will want to kind of examine this one, because this value here tells us that the absolute number is probably not too high compared to the free cash flow that the company generates, but it's high compared to the equity because the equity has been going down. So this may not be as concerning as it looks. And because of this extra debt, probably the company is getting this extra return on equity here. And you are looking at the company getting 260% of return on equity. But remember, return on equity is basically net income divided by the total assets of the company. And what are total assets? Total equity of the company. And what is total equity? Is total assets minus total liabilities. And so if the company has a very low total equity because they have a lot of debt and they kind of balance it out with what they are making, then you're having an overall expression of like net income divided by total equity that is actually going to be higher if net income keeps increasing, as you can understand. And so it is a way to manipulate this value, and this is why you're seeing that here. And we will examine it in detail, of course. But other things that are interesting here, the price to sales ratio is very interesting, and also the net income margin is rather high. And yeah, there are things that I like to see I like seeing in this company. And the income statement here, as you'll see, 1.24 pretty much, 0.24 billion to 231. The company has more than doubled the revenues in the past 5 years. And you will see here that the net income from 10 million to 725.7 million. So a massive increase in the net income that the company generates is something that I love to see, of course. And if we take a look at the balance sheet, we will kind of see the story here. Total equity that has been going down in the past year. And you will see that in the past year we're having, for the most part, a lot of extra liabilities, because the previous year we had 828. It has almost doubled here. And this is how you can kind of deduce what is happening with the company's liabilities. And you will see that this kind of view here, the view that we have in our tool, pretty much tells you the story very quickly. You can kind of see the total debt here increasing tremendously, about 600 million here. And this probably accounts for the important difference here. And in order to be more precise, you can actually take a look at the non-current liabilities here and see how they have increased, 536 to 1.14 here. So this is the bulk of the increase really, and it is because of the long-term debt. So company has gotten a long-term debt, and it can be a little bit concerning that they are getting that much debt, but we need to compare it to what they are making financially. And so if we go to the cash flow statement, remember they had less than $1 billion in debt pretty much, you will see here that the net cash provided by operating activities was 567 million here. And if you go down, you will see that the free cash flow was 511 million. And so the total liabilities, remember, if we go back to the balance sheet of the company, the total liabilities were 1.531. So it's about 3 years of free cash flow to pay back the whole thing pretty much. And the debt of the company is actually 2 years of free cash flow if you just take the total debt. So that's not concerning. Even if the company got extra debt, they have a lot of money to pay that debt. And we can even take a look at the cash that they have. They have an extra 217 million. But again, remember that they are making significant free cash flow to actually pay back their debt whenever they want it. And so I'm looking at this debt and I'm thinking to myself that they may be using it to either like buy back common stock, as you can see here, which has also contributed to the fact that their equity has dropped. Because when you are buying common stock, remember, you are spending cash. And when you are spending cash, this means that you are reducing your assets, thus reducing your total equity. But there are now less shareholders, and so the less total equity, but less shareholders, it balances itself out. Yet you see this difference in your balance sheet. But yeah, if you break it down, you can quickly see that this is normal, and actually things are looking pretty nice here for this company. Okay. And in terms of financing, right now it looks like they are paying back some debt, but also got this extra debt here. So overall, they got debt this year. And yeah, they're repurchasing common stock. This is where the bulk of their money in terms of the financing activities goes here, $1 billion, which makes sense, it looks like. But does it actually make sense in terms of the value of the stock? This is what we want to be examining next. And we will calculate how much to pay for the company today based on what they are doing. Now you will see tremendous revenue growth here in the last year, but of course we're not gonna go with that. We're gonna go with something somewhere in between these values here. So I think I'm going to go maybe even lower, 4, 5, and let's go 7 for the last one and see where we're getting. And net income margins here tend to be around, over the last couple of years it has been much better. Now, I don't know how indicative that is of the business. This is something that we can obviously take a look at potential things that analysts say, but I like to go a little bit conservative here, and I will go somewhere in between again, but not on the upper range too much. And so I think I'm going to go maybe 20, 22, and 24 here. And the free cash flow margin that we can use is probably about something like 70, 80, and 90%, and 13% for annual return. Of course, when you get access to this tool, you can try all sorts of measurements and projections, because in this video I cannot try like 100 of those. I'm only just trying some that make some initial first sense to me. But of course, when you gain access to the tool, you can try everything you like, as many other projections as you want, and different scenarios here. And if you want to gain access to this tool, you can find links in the description box below this video. You can get access by becoming a Patreon. So if we hit calculate here, you will see that the current price of the stock is sitting at $56, and with these projections that we're having here, the low estimates are sitting at $83, pointing to a company that is severely undervalued. Now, these kinds of companies, like retailers for example, can be undervalued in some situations and still not be great purchases. Yet this one looks like it's actually tremendously undervalued really, and it's looking like it's doing very well financially. Like the big thing about a retailer is that for the most part they tend to be steady in what they are doing, like in growth. But this company is still growing massively, as you'll see. Last year they grew 67%, 3-year average of 30%, 5-year average of 20%. So there's a lot of growing to do here, and pretty good margins too. So it's almost like you're looking at a tech company that is a retailer here in terms of what they are doing financially. So I love to see that. And even if I try 0%, let's actually try, let's try 0, 1 and 2 here. Whoops, 1 and 2, which will of course significantly affect the outcome here. Did I hit? I didn't hit calculate. Oops, I did. And still, it's actually 70 bucks. It's still, even with 0% revenue growth, we are still looking at a low of 70 bucks. So this is tremendously undervalued. And I really, really like this company. This is a company that I'm definitely looking to add in my portfolio. This looks great, especially when it was down even more the previous day, because it was up like 5%. And I think there is a lot of growing for this company to be doing in the next few years. So I anticipate them probably fairly easily reaching this price again at some point. But I like what I'm seeing here, and I wanted to make a video because again we had a lot of discussions about this company, and I feel like it can be a very, very interesting purchase for a lot of value investors. Thanks for watching the video. I hope you enjoyed this one, and I'll see you in the next one, guys. Bye bye.